Hey everyone, welcome to this new video on HDFC Life Insurance Company. We're continuing our Nifty 50 series and we'll be discussing all 50 companies in the Nifty index. And today it's the turn of HDFC Life Insurance Company. What's interesting about this company is for retail investors specifically, insurance sector is not something we usually dive into. It's a little bit of a different sector, and to understand it also is a little bit different. The operating margins are at 1%. There are so many new terms which are introduced in the sector. The products are very similar, and it's sometimes difficult to understand. The industry economics is also slightly tricky to understand, like how are they making money, right? So in this discussion I will only dive deeper into certain sections where I feel there is value to the retail investor, and I'll kind of keep it a little more explanations based and only dive deeper when I feel the need, there is high value. Okay, having said that, let's start off with the industry analysis of the insurance industry. So the insurance industry is basically, they are giving you products. These are either financial protection products or savings products, right? Financial protection in the case of death, right? So these are the couple of types of products which the insurance agency is giving you, and you usually pay a premium every year in order to buy these products. Okay, not sure, but maybe you guys will be familiar with life insurance or with insurance in general as a product, because it's something that we all interact with in our day-to-day life. So it's also nice to understand this industry not only from an investment perspective, but it's something that we are interfacing with on a daily basis. So if you look at the value changes to understand it better, there's the reinsurance level 1. Okay, I'll come back to it. But the level 2 are the primary insurers, companies like the LIC, HDFC Life Insurance. These are the primary insurers which have the products, which make the products. There are 24 private life insurers plus LIC in the Indian market. Then there's the distribution. Now these products are distributed either through agents. Like I got my first life insurance policy through an agent, which was a friend of my parents. Then there can be bank assurance partners. You go to your bank and your bank will say, okay, you want life insurance, we have these offerings. So companies tie up with banks. Online aggregators are there, brokers are there, corporate agents are there. 95% of the new business premiums are sourced through these intermediaries. Then there's the investment management function as well. So all the premiums that we are giving these companies, that is called float. Now this float, some of it is also invested in different debt and equity products, right? So that's a function as well inside this value chain. And then of course are the policy holders, that is you and I, that is the retail or the institutional policy holders, right? There's also the reinsurance level, which is actually an insurance where the primary insurers kind of transfer their insurance risk to the reinsurers, right? So if a catastrophe happens or something happens and the insurer had a policy which it sold, it has actually transferred the risk to a reinsurer. So now the reinsurer will pay it in case that happens, right? But we don't need to get into the depth of it, okay? But I'm taking a bit of time just to set the stage and just to understand these basic things before I continue. As compared to other videos I've done, I'm just taking some time to understand these things, okay? We'll move on to the type of players next, alright? So moving on to the types of players, there are a few ways to look at the different types of players in the industry, but we'll look at one, and that is by the ownership architecture. So some companies are owned by the public, by the government. So not by the public, by the government. These are the public sector companies, and that is LIC. It has 60% overall market share by total premium, right? So it's a big player in this industry. Then we move on to the private sector players, and there also there are two types. Either one can be bank promoted private players, and then there can be non-bank promoted private players. So the bank promoted private players are like SBI Life, HDFC Life, right? The advantage here is that some of their customer acquisition can happen from the bank assurance channel, right? We looked at it at the distribution layer, right? So they're a little bit, they have some advantage in terms of their customer acquisition costs. And then the non-bank private players, for example, Max Life, Tata, AIA Life Insurance, Bajaj Allianz, right? So these are some of the players we've gotten to know and the types of players. There's also some other ways to categorize these players, but I'm going to move on from that and I'm going to go to industry regulations. Now here there are 3 industry regulations. I'm going to discuss one which has had an impact on HDFC Life, and we'll see that impact play out when we see the business in detail. But alright, so that one regulation is this Finance Act, which was passed in 2023 or FY24. What it did was it removed the income tax exemption for the maturity proceeds from non-ULIP life insurance policies. So there are different type of products in the insurance which we'll quickly see. But except for ULIP products, all the other products they had the tax exemption for all the maturity proceeds that you got once the policy matured, right? That was removed, and what was kept was that was removed where the aggregate annual premium exceeded 5 lakh. So what this actually led to was that the non-par policies for HNIs and affluent buyers were capped. So this led to a shift in the type of policies which people were buying. These non-par policies or all the non-ULIP policies had this tax advantage which was taken away, because of which has been one of the factors that we've seen that the ULIP policies have gone up, which we'll see later on as we discuss HDFC Life in detail. Okay, there are a lot of tailwinds and headwinds. I'm not gonna go into it because, as you can see, there are almost 8 listed here. What I'm gonna do is I'm gonna assign some sort of scoring metric here to figure the importance of each item, and I'm only going to show the top 3 by impact so that it's much easier for you and I to understand tailwinds, right? In terms of subsectors, now here I can go a little bit detail into the kind of products or the kind of subsectors in this industry. There is the ULIPs, there is the non-participating and the participating. Okay, let's just keep our discussion to these 3. Quickly explain what they are. Unit-linked insurance plans are basically when you give a premium, and that premium which is collected from so many people is called the float, and that float is invested in equity or debt products, right? So your value of your it's an investment. The money you're paying is linked to the market performance of these invested assets. In the participating and the non-participating plans, in non-par it's more of a guaranteed return, okay? And in par there's a guaranteed return plus you get bonuses based on the company's performances and based on the company's profits, right? So these are the kind of simply differences in the products or the different subsectors. Alright, so again this video is a bit top heavy. We've just discussed the industry and subsectors and kind of some of the products. There's a lot of text here which I'm not gonna get into the subsector analysis, but I will quickly take a few insights which might be important. In terms of ULIPs, there's nothing interesting. In terms of non-par products, the non-par subsector experienced a textbook supply boom. So this is the section where the margins are high and the profitability is high. So what we know from our capital cycle understanding is wherever the returns are high, it attracts more investment. So a lot of companies have come into this kind of space, and it's kind of seen some boom in terms of the supply side. In terms of participating life savings, I'll just share one thing, that LIC has almost 85 to 80% mix or market share in this, right? So it's heavily LIC dominated, right? These were just a few things I quickly wanted to show you. I want to improve that section more, and then we can discuss it. But moving on to the business of HDFC Life, right? HDFC Life, to understand it, let's just look at the business segments. It has 4 major business segments or 5 major business segments, but there's the ULIP segment, there's the participating segment, there's the non-participating savings, right? All of these 3 things I've explained simply what they are. There's also a term protection in which you only get money if you die within the protection period, right? So there is no payment made to you when the policy matures. And there's also an annuity, 4% of revenues, which is more of a retirement product where you give your money straight up and then they keep giving you some amount every year, right? So that's the annuity product. If we look at what has happened in terms of growth for the company, the data is not great here, but let's actually go to the mix shift. This is interesting, and both of them are pointing to the same insight. Okay, if you look at ULIPs have gone from 23 to almost 39 and 43% latest mix, and if you see non-par, this has gone from 35% to 19% for the company. Par has remained almost same. Term and annuity are too small to discuss. So we have essentially seen a shift from non-par savings to ULIP products for this company, right? This is the kind of insight which we are seeing. Is it good? Essentially for the business, it's not good, because non-par savings is a higher margin product for the company and for the industry. So it's not good that the mix shift is moving towards a lower margin product. However, the management has said that they have made ULIPs, also the margin is increasing based on, I don't know, there's some term which they used, but basically they're saying ULIP margins have also been increasing in the last few years, right? Let's just quickly read the investor takeaways. So ULIPs have seen a rise from 19% to 43%. This one is margin dilutive at the segment level, which I just mentioned. Okay, non-par savings has been a collapse of structural chain, but it reflects disciplined margin protection rather than demand erosion, right? So this is what I was saying earlier. This segment in general in the industry has attracted a lot of capital flow, and HDFC Life, which is very prudent of them, instead of kind of competing, they have been like, okay, you take away market share, but we are not going to increase our risk by giving by collecting lower premiums or their pricing or whatever, right? So they have been good in that sense, I like that part. So yeah, this is basically it. Even the revenue growth table is kind of giving the similar investor takeaways. Structural shift there, it's also saying that the ULIP mix was also helped by the great market performance. So everybody was a bit greedy that okay, markets are doing great, let's buy the ULIPs instead of the non-par savings. So yeah, these were the 2 kind of takeaways from how the business has progressed in the last few years for HDFC Life. Okay, now we'll dive deeper into some other stuff of the company. Okay, having understood the industry and the company a little bit, let's see what's actually happening with the company recently and where is it going from here. Okay, in terms of the quarterly score, the trend is stable. It is kind of in the yellow category, neither great scores nor bad scores, right? If you look at some of the details of what happened in the latest quarter, There was the GST impact which happened, right? So in terms of the GST impact, I think GST of 18% was taken away from one of the categories. So that led to kind of repricing, and the distribution, they had to renegotiate with their distributors, right? So there was this impact from term insurance was the bucket from which the 18% GST was completely removed. So essentially it became cheaper for the end user, right? So they had to commercially renegotiate with distributors to calibrate the cost structure. APE grew at 11%, VNB margins at 24.4%. So these are both terms which I'll explain to you when we go into the key variable tracking, okay? Strong acceleration in the high margin retail protection. So term protection, I mentioned that non-par savings have very high margins, but term protection actually has the highest margins among all of the 5 products in this company. Obviously it's a small share, so that's why I didn't go into it. But ever since this GST, it's been growing at like 70% YOY. Sounds great, but as I said, it's just a little too small to kind of move the needle for the company. And the long-term goal of doubling their key metrics every 4 to 4.5 years is what the management is saying, okay? We'll kind of reiterate this when we go into the guidance tracking of the company. All right. Okay, so now moving on to the key variables of the company. The number one is the VNB margins, okay? VNB is value of new business, right? So these are the kind of new policies and the new premiums which the company is getting. And if you see the margins on the new business, you will see it's in red. Now the story that we are seeing about HDFC Life is now correlating with the story that we're seeing in the numbers, right? And that's the purpose of this portal, where the story and the numbers are kind of coming together. Now what this is if you look at the trend interpretation, we kind of see that the margins peaked when the non-par savings products were at the peak. They were like 45% of the mix. These were the high margin products. Ever since then, what we have seen is that ULIPs have gone up and non-par has come down. ULIPs have less margins. So we're clearly seeing that reflect here as well. Like, this is making sense to us, right? 13-month persistency, right? This is if people are still paying their premiums or not. It's a metric of that. So there has been a 200 BPS drop in 9 months of FY26, right? But this is concentrated in a specific cohort of the non-par policies, which were high ticket, above 5 lakhs probably, because of the income tax withdrawal. So there has been some lapses going on there. In terms of the retail protection growth, this was the fourth revenue segment, which was the term protection. We are seeing that it is the growth rates have really improved, right? From being a 25% growing section, this has suddenly become a 43% growing section, and this quarter the YOY was 70% growth, right? So we are seeing accelerated growth because of the GST cut from 18% to 0. Now HDFC Bank counter share is almost 65%. It's stable. Obviously HDFC Bank, because of the competitive intensity at non-HDFC Bank partners is really high, right? So it's not being able to increase its distribution away from HDFC Bank. And also management is being picky in participating in ULIP heavy products, right? So that's why it's remained stable. It's not aggressive. I think it's prudent in my opinion. And operating returns on embedded values. Embedded value is another metric which is specific to the insurance industry. And basically the thing to read here is that the returns from embedded values have kind of gone down since FY23. They've also been in the red, right? What's happened here is margin compression is one factor due to the GST and the labor code impacts, right? So margin compression, it's being said, has led to the lower returns on the embedded value, right? We'll quickly discuss growth next. Okay, I'll quickly try to wrap up growth and guidance in the next 5 minutes. In terms of growth, it's got a healthy green score of 7.8. If you see where the growth is going to come from, it's going to come from already we are seeing this, the GST cut has led to the term protection plans seeing really good growth rates of like 70% in the last quarter. So that's going to be one catalyst which is already playing out. The agency channel productivity and scale, expansion of physical footprints, so distribution they're working on through agencies and their own branches. Not agency but agents and their own branches, okay? Agency channel contributes higher protection mix and reducing dependence on HDFC Bank while improving fixed cost absorption, right? So obviously 65% of their premiums are dependent on HDFC Bank. They want to lower it if possible. Project Inspire retail rollout. So they're kind of upgrading their tech so that things become better in terms of straight through processing for retail claims and automated underwriting. Technology is coming into the insurance sector. This is a trend I'm seeing in general. Okay, scenario analysis, base case 12 to 14%. It seems accurate given what we have seen. Quick takeaways that the retail protection momentum sustains, GST impact will be neutralized, allowing for VNB growth to track APE growth. Value of new businesses growth to track the annualized premium. I forgot. These are so many terms are there, but it's basically the kind of premiums which are coming in every year, which is it's the value of the premiums which are rolling in every year. Okay, quickly coming on to guidance, and you can see the new design system in place. In terms of guidance history, the direction style has been directional. The big picture growth for this company is the consistently outpace sector top line growth and double key metrics every 4 to 4.5 years. Doubling every 4 years basically means I think 18% growth. APE, VNB, embedded value, these are the key metrics, and that is what they want to double every 4 years, grow at 18%. Credibility verdict based on what we've analyzed below has been given credible. Consistent record of meeting directional volume commitments. Proactively adjusting distribution commercials to defend margins against the regulatory headwinds. Operating commitment delivery is weighted. Okay, there's some cut in the text, but yeah, this is a tough industry to operate in. There is also a lot of impact of regulations. They have an impact on the operations of the company, as we have seen, right? So the management has done a good share. Management aspires to, so for this year, management aspires to grow faster than the overall industry and private sector, right? Have they given any guidance in Q3? They said 11% growth in Q3. Expect this volume driven momentum to sustain into Q4. Okay, so targeting an outperformance of the industry's 10% growth rate. Basically, they're not giving exact numbers, but this is kind of the feel of the guidance. The guidance has been in line for the last 2 years. That's really great. And we're kind of tracking a few things. We're tracking the mitigation of surrender regulation margin impact. There's another margin impact of the GST neutralization which has happened. So these are some things which are tracking. In both cases, they said initially they will take a hit of 100 BPS on the margins, but then it was only around 30 BPS. Then they said there will be a hit of around 300 bps, but it's only coming out to a 200 bps. So in both ways, they've kind of scared the investors, but then kind of beaten. Under promise and over deliver is the pattern I'm seeing here, right? So this kind of completes our discussion on life insurance. For a retail investor, it's a bit of a difficult sector to be in, but I guess that can be an edge as well, where not many people are coming in and can make a mistake. So thank you for watching.